get started. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, hell is coming, and it's going to be worse than you think. And we're now seeing fractures in the banking system start to reappear at a time when the data is indicating something the political elite said could not and would not happen. And what it means is we're now not long before we're deep in an all-out financial crisis. Let's over to Bloomberg, where he picked today's story up with a headline: as clogged bank balance sheets cause key repo funding rate to spike. And this is a dangerous problem because what it means is banks are desperate for collateral. And when we talk about collateral, we mean treasury bills, things that are very liquid. It can be easily bought or sold on the marketplace. And one of the problems is banks need collateral, financial institutions need collateral, and lots of other institutions need them as well, but many of them borrow, in fact, borrow from other people who have borrowed, creating chains of borrowing on top of borrowing. And when things start to get bad, those that have collateral decide that they want to keep it, and those that need it decide they want it, and all of a sudden the cost to get it spikes. And that's what we're seeing in the secured overnight finance rate, as it spiked 7 basis points to 5.4% on July 1st. That matches the highest fixing in 6-year-old benchmark that reached on January 2nd and December 28th, indicating that there is a mad dash for collateral. So when the banking system starts to see things are going wrong, what you want to do is find out that you've actually got collateral, because if things go wrong and you don't, well, it means you're headed toward insolvency in a very quick fashion. And that's still reawakened volatility around the key quarter end funding period seen last week, when banks tend to pair repo activity to shore up balance sheets for regulatory purposes, and borrowers either find alternatives or pay up. And that's the problem here, because you see these chains are called repo chains, where someone borrows that has collateral, but then they lend it out to make money, and then lent out again and again. And you find out that going into a crisis, everyone that's supposed to have collateral on paper actually doesn't hold it, and now all of a sudden they get desperate for it. There's not enough in the system, and the price to get it starts to spike, and this is a red flag in the banking system. And at the same time, the glut of government debt sales means more collateral needs financing from the repo market. What we do need is a government to issue more T-bills and maybe eventually change the regulations so they cannot borrow collateral, but for the moment, that's how the system works. And stopping QT would help prevent the background from deteriorating further, but I don't think stopping QT would materially improve the environment. This from the head of U.S. rate strategy at TD Securities, and I got news for them. That's not going to make a difference at all, because the Fed isn't unwinding T-bills. They're unwinding notes and bonds. Of course, stopping QT would make absolutely no difference here. What we do need to see is the federal government issue more T-bills and require those who need collateral to actually keep a hold of it. This is something that could come out of the next financial crisis. So again, when you see stress in the banking system, it means that banks are seeing problems starting to form. They're making a mad dash for collateral before it's too late. And it's really a function of the cost of cash starting to rise somewhat as we go from extreme abundance of liquidity to a more normal environment, or perhaps even worse, something is saying that things are actually going to find or their way in damage the banking system, and they're trying to hedge their bets already. But something there isn't an abundance of, well, that's crude oil. And while people are headed to the pump and complaining, our subscribers are smiling because every time they fill up, they're making money. Here you can see the data today. Crude oil inventories dropped a ton. Distilled stocks, 1.5 million barrels. Gasoline inventories down 2.2 million barrels. And what that means is, back on June 12th, we told our subscribers, you've got to buy crude oil. This was our CTA Timer Pro report, because we saw the machines were in a deep short position and price was rallying against them. We gave them data. We said, this is the entry point, this is a stop loss, this is our upside target, which we've crushed through in a big way. And look at these returns. They're up 5.57% since June 12th. This trade on the books less than a month. And again, every time they're filling up, they're making money, and you can too. We give you trades all across the equity index, commodity markets, bond markets, currency markets, and all you have to do to beat the machines is take advantage of the link in the description below. There's a 30-day free trial for both of our reports, and once we go full AI, prices going up on both of them, and we're going to optimize these reports to help you make even more money trading than you've ever made before. Because here's the problem the political elites have been saying is not going to happen. We warned this day was coming, and U.S. continuing jobless claims have now increased for a 9th straight week. They said that was going to peak. We said it was unlikely, because what you're seeing here now is people are going on unemployment, and that's fine if people lose their job as long as the market for labor is strong enough. They can eventually and very quickly find another job. But the issue becomes is when continuing claims starts to increase, well, it means there isn't a very strong labor market, and that's the exact opposite we hear from both the Federal Reserve and the Biden administration, who says the U.S. labor market is strong and robust. Well, here's the deal, not for much longer. Continuing claims are proxy for the number of people receiving benefits increased to 1.86 million in the week ending June 22nd, on its way to breaking 1.9 million, and that is a danger zone. First-time claims rose to 238,000 last week. And keep in mind, the level of recurring jobless claims points to a more limited demand for labor as the economy slows under the weight of higher borrowing costs. And really, it isn't an issue of higher borrowing costs because, well, if the economy was booming, well, then it would have no problem absorbing higher labor costs or higher interest rates. The issue here is we continue to hear how strong the U.S. labor market is and it's powering the U.S. economy. We've said there was issues here, and well, they're certainly bigger than anyone can believe. And at the same time, the number of initial applications indicates a gradual pickup in dismissals. That's going to head a lot higher. But let's talk about the real reason continuing claims are going up is because there's not enough money in the system. And what happens when central bankers such as the Federal Reserve raise short-term interest rates higher than market expectations, well, what that means is they invert the yield curve. And because banks borrow at the short end of the curve and lend at the long end of the curve, an inverted curve means banks actually lose money on the interest rate spread, so they tend to curtail the lending activity, and that leads to less money being created and injected in the economy, and at some point you reach an inflection point. We talked about this in yesterday's show where there just isn't enough money to sustain economic growth and cover all the debts, and that's when all of a sudden things go wrong in a big way, and we're now starting to see that today as continued unemployment claims shown in red here against the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes, and that's shown in blue. And anytime that blue line's above the horizontal black line, it means banks make it harder for you and I and businesses and everyone else to get a loan, leading to fewer loans being originated, and that curtails the creation of credit in economy. And you can see here that leads to a rise in continued claims, and that happens each and every time. Now, this time it started to, but the economy kind of bounced back under, of course, the fact that pandemic stimulus stayed in the economy longer than we thought it would, but now it's starting to rise, and you'll see a breakout over 1.9 million continued claims, which could happen in a matter of weeks. Would be very bad news for the U.S. economy as everyone's pinning the second half turnaround for the global economy on the U.S. consumer. Well, the U.S. consumer is likely headed to the unemployment line, and we just heard from Challenger Gray and Christmas that it is high-paying jobs that are headed onto the employment line. U.S. employers announced 48,786 cuts in June, down 23.6%, which is the good news from the 63,816 cuts announced 1 month prior. But here's the problem. It's 0.8% higher than the cuts announced in the same month of 2023. So what we're seeing here is demand for labor is declining, because if it was going higher, well, then the companies would not be laying off people. So this is a red flag for the labor market. It is the highest total for June since 2020, when 170,219 cuts were recorded. Keep in mind, we're cut in the midst of the pandemic, and outside of 2020, here's the red flags. So we're not just seeing the banking system, but look at the labor market. It is the highest June total since 74,393 cuts were recorded in the month of 2009, as we were, of course, still coming out of the global financial crisis. So this is a major problem. We're seeing high-paying jobs here because these are announced ahead of time. As June is typically a low month for job cut announcements, well, not this time, as most companies are mid-year or end of year for their fiscal years. The months following fiscal years tend to have a spike in cuts as those plans are implemented. And over the last decade, job cuts have primarily been announced during the first half of the year. Prior to 2013, though, major announcements would bookend the year, indicating that there is no sign of a second half rebound here or soft landing that the Fed is hoping to engineer, or even a no landing scenario. What's reality is we're about to head another leg lower in the economy, this time on the back of U.S. workers losing their jobs, and this is dangerous. And companies cited cost cutting as their main reason for doing this, and market and economic conditions. And you only cut costs when business is slowing, and that's exactly what we're seeing. And not only that, but projections. And this is interesting because we know that, of course, investors are max long the U.S. equity markets, continuing even today to take it to new all-time highs, bidding stocks up when they can't actually see that companies are saying demand is coming down. I've been warning this could be for many companies the last good quarter of earnings, and after that, watch out below. And you can see even some announced due to store unit or plant closing or restructuring. Again, not good news. But if you're looking for hiring going on, well, it's not that great. In June, employers announced plans to hire just over 19,000 workers, the second highest monthly total so far this year, but it's the lowest year-to-date total for announced hiring plans since 2016. So again, we're seeing very clear evidence that the U.S. economy, more importantly, the U.S. labor market, is doing something the political elite said cannot happen, because if it does happen, it's all but a certainty now. We're headed into a recession that's likely to be here before, of course, the November presidential election. Initial claims before adjustments for seasonals increased to 238,000. New York, New Jersey, and California showed the largest increases. Kind of interesting, California, given their recent hike in minimum wages. But here's the issue for the broad economy, where continuing claims go, and this is what really has me concerned here, is initial claims follow. Because think of it, if someone goes on the unemployment line and they can't find work, well, their spending is going to get cut back because, of course, their checks are lower. They still have bills to pay. They still have expenses and food, rent, energy. And we know energy costs are rising right now. And what happens then is their lack of spending leads other people to lose their jobs and go on unemployment. The problem is for those people entering unemployment, they're finding out now there's no opportunity. And that's why we see on this chart, we have initial claims shown in blue against continued claims still in red. And what you see is where continued claims go, initial claims follow. And this is the big fear right now, that the two spiral out of control. You see continued claims break over 1.9 million, and the odds are we're going to see a big spike in initial claims. And from that, a panic by Fed Chair Jerome Powell. Will we get a July cut? Probably not, but that may depend on what the non-farm payroll report says on Friday. But if ADP is indication, it's going to be a little weaker than the market expects, because more evidence that we're headed into hell, and that is, of course, when U.S. workers are on the unemployment line, and lots of them. Well, ADP says there's more signs of a slowing labor market. In the ADP data, 150,000 gain in private payrolls last month largely reflected an increase in job gains within leisure and hospitality. So as Challenger Gray and Christmas noted, these are large layoffs from higher paying jobs. Those are being notified, and those people are on their way out. The jobs we are creating are low wage leisure and hospitality. That is not good news, although that is very seasonal and to be expected, not the news we needed. ADP notes that job growth has been solid but not broad-based. It had not been for a rebound in hiring in leisure and hospitality, June would have been a downbeat month, suggesting the report would have been negative. Could you imagine the market reaction? Instead, the market goes up. The case is, what will non-farm payrolls? But will we see Fed Chair Jerome Powell do anything? Well, he said just on Tuesday that there has to be a substantial move toward balance in the labor market between supply and demand for workers. By the time he figures it out, it's going to be very much too late. And that is the problem here, because once you start to see the unemployment market spiral out of control, the Fed can cut rates all they want. It won't make a difference. And more evidence demand is coming down as wage growth slowed for the third month in June for workers who changed jobs to 7.7% from a year ago, as well as workers who stayed in their jobs saw a mere 4.9% annual increase, the smallest since mid-2021. And with gasoline prices headed higher on the back that energy prices are headed higher, this is not good news for people who are working that are struggling to keep up to begin with. But we can note that it's a clear indication of lack of demand and need for employees. And when you see average hourly earnings, as shown as production and non-supervisory employees in blue, that on a year-over-year rate of change, as that decelerates, because if you don't need as many workers and you're sending people onto the unemployment line, well, those who still have their job, you can give them raises, but you don't need to give them as big of raises, because what happens is they start to believe they could be next, and their demand for higher wages starts to get cooled off a bit. And here you can see the two become in sync right around the dot-com bubble. Prior to that, you could see continued claims rise before average hourly earnings decelerated. Now, more in modern times, you see the two in sync, suggesting that as average hourly earnings continue to decline, that the direction for continued unemployment claims is going to be higher. And again, this is all studying up a recession and then all-out financial crisis, because we know the banks are still in a dangerous place right now as we head into the second half of the year. And Fed policymakers will get further insight into the state of the labor market this Friday, again with the non-farm payroll report. This is the one they're going to follow, and this is a question I'm wondering, is the government going to cook the books on this report and make it look good? Because if they do, it's a double-edged sword. If it looks bad, then it gives the Fed some latitude to a potential cut, if not in July, but maybe by September. If it looks good in trying to promote how great the U.S. economy is, it could keep the Fed on hold for too long. It's a dangerous game they're playing, and economists anticipate 190,000 gain in non-farm payrolls, which we'll know will probably get revised down, because that's been the trend lately, is they overestimate every month and revise the ones down when we see the report. But we can see further weakness in the U.S. economy as evidenced by the housing market, as U.S. mortgage rates push back above 7%, slowing financing activity. And when you get a slowdown, what happens? People that are, say, realtors or in the mortgage industry or builders or workers, anybody supporting the housing market, even retailers, maybe there's furniture retailers or things like that, or appliances that cater to the housing market. Well, if demand goes there, of course, that means workers go as well. And here's the evidence. A gauge of mortgage applications to buy a home fell 3.3%, the first decline since the end of May. And the drop indicates potential home buyers remain sensitive to changes in borrowing costs and suggests a bumpy path to a more durable recovery for the housing market, or perhaps indicating the housing market's about to go bust too. And even the index of applications, which includes that for refinancing as well, so 2.6%, and that is problem, because it means, again, people in the mortgage industry likely to see job cuts there as well. What we're seeing now is broad-based demand across the U.S. economy outside of leisure and hospitality start to decline. And what this means is all hell is coming, because that is what happened when U.S. workers hit the unemployment line and have no opportunity to get back to work. And that means debt defaults come very quickly after that. And with that, an all-out recession and financial crisis. I'm your host, Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.